Well, I am one step beyond Rubini. I said there was a recession 2 years ago, come up 1 week from now, and this week I have said that we are already in a depression. And Mr. Rubini and Schiller and a handful of others were about a year behind me, and the United States government discovered it last month that we had a recession. Mr. Rubini is right about his numbers, and all of the major banks and brokerage houses, many of the insurance companies are broke. They're lying about what's on their books, and we know that because we've seen them have to come back. And like Bank of America, we need 20 billion more, 10 billion more. The next day they wanted 20 billion. Now they're talking about another 60 or 80 billion. They should have all just been taken over by the government and reformulated, the losses taken, and the deck should have been cleared. I don't think they really understood the gravity of the situation, they being the Fed and the Treasury, but particularly the Fed, because most of them are shareholders in the Fed. And so this thing is going to linger on for a long, long time. They've been increasing money and credit for 5 years, and I'm talking about the G20, of about 14%. They're pouring goo-gobs of money into the system, and we're talking $12 to $13 trillion, I think, by the end of this year. And with all of that said, we're going to have hyperinflation first, and then sooner or later, deflation's going to break out, and then it'll become full-blown depression. So I'm a step beyond Rubini.
It's beginning to look like we will see continued deflationary forces as these trillions of dollars of debt in the form of credit default swaps and structured investment vehicles keep crashing. I'm concerned that we may see another 6 to 12 months of deflation, or at least what appears to be deflation, and that could keep gold in very good position. I think it might repress silver, and I think that short-term treasuries remain a very attractive place to invest, especially with around 3.5% return on ticker symbol SHY, as I outlined in detail in my newsletter this week and in last week's show. Ticker symbol SHY, the short-term treasury ETF. You get a monthly distribution, a monthly paycheck sent to your house. In this type of inflation/deflationary environment, I have to go with gold as the best asset class and then very, very short-term treasuries. And I'd like to shift over here, Bob, to the next pundit, and that's Lindsey Williams. I'm sure you're familiar with him. I've interviewed Lindsey. I've been a big fan of his work for some time. He was one of the few folks out there who correctly predicted that oil would run to $150 and then crash below $50. So I'd like to share a few of his latest predictions in the past week or so. Lindsey says that the powers that be crushed the crude oil market as an act of economic warfare against the OPEC nations, particularly the Iranians, who just opened up their own oil bourse, and guess what they're trading in? And it's not dollars, Bob.
Perhaps euros?
And their primary concern, though, are those oil contracts trading in euros, as Bob aptly pointed out, instead of the greenback. So our listeners with weak hearts are now advised to mute their audio devices for a couple of minutes. His next prediction, I think, is even more disturbing. Williams says that in the year 2009, the entire economy and the dollar will experience total collapse in value, and that it will take many years to recover.
Possible and probable. I just don't know the timing. What he says is correct. I'm saying 2 or 3 years, but it could be 4, it could be 6 months. We don't know, but we know that the G20, all of them have been doing the same thing. They all have zero interest rates, or will have shortly. They're all increasing money and credit in an average of 14%. What do we expect? Yes, he's right. We're going to get it. When is hyperinflation going to end? Probably in 2 or 3 years. What's going to happen then? And that kind of fits with what Mr. Williams has said. We're going to have a breakout in deflation. And the game is going to be totally over. And then, 2 years perhaps from now, everybody's going to look back and say, gee, we had a depression that began in 2009.
You know, Bob, the credit crisis has led to trillions of dollars in debt destruction, and this has had a surprisingly deflationary effect on this inflationary economy. Now, you know, mountains of credit default swaps, 20, 30, 40 trillion dollars, as that debt implodes, it effectively offsets all of the global banks and governments' fiscal and monetary intervention. Now, under such conditions, few asset classes such as stocks and corporate bonds, even many commodities, perform very well. You know, so many people are opening up their 401k retirement accounts right now, pension funds, and they're finding 30, 40% or more declines. Having lost, it's shaken the conviction of many investors. And I'd like to wrap up this portion of the show with a brief discussion on portfolio and money management. When sudden losses occur, people have a natural tendency to try to hope that the markets will return and wash away their losses. There's an old saying, you may have heard this, hope is the last thing to leave you. By then, the money is long gone. And I think that this saying is apropos for investing as well. The best way to view our losses is that the money is already gone. It's time to turn our backs on what's not been working in search of the new bull market. For instance, the typical investor has watched his $20,000 portfolio of stocks drop to $10,000. Should he hang on for a recovery or make some changes? You know, if you take a look at the Dow Jones Industrials, over the past 10 years or so, the Dow has been treading water like most stock indexes, showing losses. So over the past 7 years, though, the yellow metal gold has provided a return in excess of 15% per year. It's had a winning year for every year since then. Even last year, we showed a 5% gain, while almost every other asset class was in decline. So for those who have lost heavily, I have a very basic solution that I think might help them to sleep well at night, no matter what happens to the economy, and make back everything and more that they may have lost in the past year or so. I suggest taking all investing funds that aren't needed for basic survival and bills and pouring it into gold bullion and related coins. The 40% loss will be more than compensated for, I believe, as I expect gold to run from the 800s to the 1600 level and higher in the next 12 to 24 months. You won't have to worry about banking holidays. That won't affect you. Dollar crashes, stock market collapses, you'll be completely insulated.
I agree. I only have two additions. I don't think that people should leave out numismatic coins, and especially in gold numismatic coins. And of course, I have a great love of the gold shares, particularly the blue chips. There's three that I recommend, and that will give you leverage. And if gold is going to do what Chris and I think it's going to do, just let's say it doubles, then some of these better quality stocks could go up 3 or 4 times. And I've been through every bull market since 1963 in gold, and it's acted the same way, and the shares have as well. And even during the Depression, Homestake went from $50 to $665 a share. So I think Chris is absolutely right. And it's a long-term investment. We've been in a bull market in gold and related assets for a long time, and it's going to continue until this mess is over with.
You know, Bob and I had been discussing that even during deflationary episodes, gold holds its own. I mean, the whole world's debt structure and credit foundation is in full decline mode here. Gold, the asset class to own. Don't let the bull kick you off. We want to be bull riders and hold on for the whole run here. Now, regarding numismatics, I would like to throw my 2 cents into the ring here. Huge fan of numismatic coins, American Indian head gold coins. I think they're just classics. But I don't suggest that the typical investor start off with numismatics. I would certainly want to build up a very strong core of gold and silver related bullion first near spot prices, and then perhaps with some excess income that you've earned off of those gold stocks that Bob has recommended, you lock in some profits, take those profits and buy some, if you will. There's so much propaganda